Ladies and gentlemen, my name is Tony Smith from Canation Capital LP, and I would like you to welcome you to the tax briefing for Tipton train delegates. We'd like to clear what the objectives and outcomes are for this session. We're not going to be too ambitious. Simply about to tell you about 6 steps that a delegate can take to save tax today and future. We'll be able to do a great deal based on information we are going to give in this short time. My objective will be to cause you to give it some time. In other words, to cause you to prioritize dealing with your tax planning, to perhaps give it a little bit more attention than you are right now. Is right now, you probably start work for the government sometime on the day. When you set out on this journey, that wasn't your intention. And intentions is that it's not necessary. We will, through the course of the next 30 or so minutes, equip you to take action, to start to reduce the burden that's there upon you. And for us, of course, it's like what we say, and then you follow through this webinar, and we need to contact us because we are here ultimately to help those Tipton delegates hold more of that profit that you're working very hard right now to acquire. The irony here, you're working very hard with Tipton to increase the turnover of your businesses, to provide a benefit to your clients, grow that bottom line of the business. And quickly, the more successful you are, the less of money that you generate you'll keep. Okay, so simple objectives, I think, not too ambitious, but not too small either. So how am I going to try and achieve those objectives and outcomes with your good selves? And you're going to do 3 things. I want to spend the first part of the webinar talking to you about the tax environment as it exists in 2011 and 2012. Then I'll talk to you about how you can save tax in the future and come back to the position and talk to you about some of the things that you can do to reduce your January 2012 tax bill. So I hope you find it useful. So let's get started. Okay. The environment, if you look at it, is potentially confused. The government trying to do various things, conflict priorities, and when you look at some of the things that they're doing, you can see the sense in some things, but sometimes you begin to scratch your head. Hence, it may be a little bit confused. It's certainly not got any strong themes in it. Danger and of a greater risk to you is the fact that it's actually quite confusing. In the past, you may have had a clear idea on what your plans were in and around the tax environment. So, what do I mean? If you just look at this next slide, and it's like, isn't it? I mean, if you just follow me left to right, over here, personal taxes go up, taxes go down. Rates of capital gains tax are going up. Capital gains tax allowances are being increased a great deal. Regular stamp duty's gone up. The actual stamp duty has stayed the same. Breaks have increased. The tax breaks, the lower the tax bill. Tax relief has been reduced hugely. You can make less tax provisions that way. So the question becomes, which way is your tax bill going? And if you get it wrong, you would find that you're in a place where the only thing that's happening is your tax bill's going up. Yet if you get it right, the tax bill will go down. That most people aren't doing a great deal, so they bounce along in the middle, knowing whether their tax bill's going to go up or down this particular year. Just look at some of this stuff. I don't want to spend too much on it, but I will run through some of the changes that have taken place in the last 24 months or so. Right now, if you include national insurance, your height of personal tax has increased to between 71% and 58%. If you're lucky enough to earn income between 100 and 130,000 pounds, you pay the highest rate of income tax in the United Kingdom right now. What happened? It's being reduced quite aggressively. Small will eventually pay tax at 19% and larger companies at 24%. If business, and you know that business, capital tax has reduced 10%. And you're allowed now, instead of £2 million, you're allowed to make £5 million. At 10%. If they were husband and wife in a partnership, then £10 million for both those partners, and the rate of tax would be 10%. However, if you make more than that, the business capital gains tax has been increased by 180% from 10 to 28%. To sell an investment and make a capital gains tax, they've also increased that rate of tax from 18 to 28%. So there you have it. Let's go. Certain allowances that very few people know. The thing, premises renovation allowance that I'll tell you a little bit about later. Last budget, this was extended from 2012 until 2017. I mentioned this later, but this is another government allowance called Enterprise Investment Scheme allowance. The income tax relief on that in the last budget was increased by 50%, from 2% to 30%. The amount that you test in one of those schemes has risen very significantly from £500,000 to £1 million. Again, little known government allowance called allowances is under review. Change either at the end of the year or in the budget. Now, well, this is one where right now they're paying back quite a bit in claims. So I guess is they're going to reduce the benefit in this area. They're certainly not going to increase it. That have made any pension contributions in the past know that the rates at which you can contribute to a pension and receive tax relief have been drastically reduced, as you can see, from £215,000 to £50,000. So you can see my contention that it's confused and confusing. What's confusing is some of the changes are not highly publicised and occurring rapidly. There are times that rules and regulations change is no longer annually. It can happen several times during the course of the year, and these things often go unnoticed, and so reviews go unnoticed. structures, the way that you set up your business, do you do that as a sole proprietor or as a partnership, as a limited company? It used to be that you could make that decision at the beginning of your career, and that structure would live with you for the entire career, 20 or 30 years. It was a long-term decision. Now, you need to be flexible. Say that you invest in time significantly with the Tipton team to learn, to become experts, to differentiate yourself in the market. So you actually have less time to advertise this sort of information. And the information is confusing and therefore difficult. And difficult to draw conclusions. I tell you, it's similarly confusing for your advisors. Our advisors are 100% in your profession and making huge efforts to keep up with just these aspects. Then they'll be pretty confused as to what's good for you right now. So, whether the government wants it this way, I don't know why it's this way, but it just feels to us that there are a few people really ploughing a very clear route through what's happening at the moment. On. Your tax rates are going up, company tax is coming down. So you would be taxed as an individual, or should you be taxed as a company? If those tax rates are going up, but the allowances for entrepreneurs, then you might want some of your income or your profits to come out as capital gains tax, because that entrepreneur's relief help you reduce the tax burden. Tax have increased. So know what the tax breaks are, and are you using them all? If you're having pensions tax reliefs reduced, are you sure that you're using the appropriate levels right now? Again, make sure that the tax burden is as small as like it. So let's go on a journey and let's have a look. If we make sure in all these circumstances your tax bill is going one way, I think that's extreme sense of Canadian capital and training, where high tax is optional, where they choose not to pay tax at higher rates, or in many clients, certainly around, rate tax for them is accidental because they've been so busy money that they haven't invested the time to explore their options. So actually, they're paying higher rates of tax on an accidental basis. They just run out of time. I'm making it up. I don't think there was a recent report here from an organisation called Unbiased.co. It's a research company largely funded by financial advisors, and their report came out. Brist's $13.5 billion in unnecessary payments to the taxman. Now, large amounts of that £13.5 billion are based on people not claiming their appropriate credits, something like £8 billion. So that is people pay basic rate tax, paying too much basic rate tax, so probably anywhere between £5,000 and £20,000. Only leaves £5.5 billion to those people paying higher rates of tax. That is a significant amount of money that is being paid in unnecessary tax. It's spending 5 or 10 minutes on the Unbound website just having a look at that. If you'd like a copy of the website or you'd like a copy of the report, just give us a bell. Another example. Over 2 million commercial properties in the United Kingdom. Turned out, both from Inland Revenue figures and Deloitte's accountants' figures, that 96% of these properties have not claimed the appropriate level of allowances. Now, really first call to action in the webinar. If you own a commercial property, it's essential for you to speak to us as soon as possible. You only have 6 months left to make this claim. There is a review going on in the area of commercial property allowances right now that you could be sat on several £1,000s worth of allowances in the building that your practice or an investment property have within it. If that claim has not been made by April 2012, you're likely to lose the right to claim. So please, I know you're busy, just to contact us and we'll tell you whether you could qualify for this allowance. Okay. Are we? Capital. Well, I've been asked by Tipton if we could briefly bring you guys up to speed in all the areas that we look at. Because before, Tipton are in the business of helping you increase your professionalism, increase your expertise, and increase turnover, and hopefully your profit. At least we'd like to help you keep more of that money. Simply, we are a collective of experts. We have access to some of the greatest ideas and minds and people in the country. We spend much of our time talking to people around the country, specialists in each area, to find out what their ideas are in terms of how to run businesses, how to set oneself up in order to mitigate tax if that's what you want to do. We're not experts in everything. We put our attention very carefully on the needs of individuals, businesses, and affluent families. Groups of people all have issues within them. If you go over that specific professions, dentists, then we can start to see some themes that may well help you going forward. The current position might look a little bit like this. You'll have an accountant. The accountant will either be forthcoming with advice or be just simply act as a historian. You will send books to the accountant, and the accountant will come back to this historical account of your last year, this is your tax bill in January, and this is your tax bill in next year. You have a financial advisor. Now, perhaps your financial advisor isn't quite as much of a historian. He may have, or she may well have, a crystal ball out, and he'll be asking you questions like, want to happen if you die, you want to happen if you are ill, and how much would you to retire on? And it's literally projecting out into the future and trying to get you to make steps. But two, really speak to you, or read what the other one's trying to do. And you know that each of those advisors think the other one is sitting down with you and saying, what tax planning are you going to participate in this year? Because the tax planning steps that are available from a financial advisor, and then only available from an accountant. Quite simply, we're to work alongside your accountant and your financial advisor and fill the gap. Fill the gap between the historian and the person looking after your future, help you fully with your tax commitments in the interim, and present a united position to understand what you're trying to achieve, to understand your business, and then perhaps communicate that back to your accountant as to how we think it might be better for you to be structured, or your financial advisor should be arranging things. Makes sense. So they're on a generic high-level basis. Okay, let's now get to the bit you've all been waiting for, which is how I plan my tax. Well, except to start with, products, buying or investing in things that tax advantage to them will tend to deal with your short-term tax bills. On the other hand, the way you structure your business will deal with your medium and long-term tax liabilities. It's important you have an eye on both. So let's first look at structures. So we'll go to the future a little bit. And let's consider the following questions. Ask this question. Is my business structured in the most tax efficient way for now and in the future? Is my business structured in the most tax efficient way for now and in the future? What do I mean? Well, some business structures that you may have seen. Those people tend to fall into is the one on the left-hand side, where you simply set up as a sole proprietor basis. That means you are self-employed and you are the principal of that organization. You may be on contract. You may just have a self-employed contract with another dentist. You're paid on a Schedule D basis. Insurance, the tax bill that you will face in that arena is 40 to 50% on profits over £35,000. For the sake of this, I've ignored your personal allowance. Effectively on that, if you're a single individual, then you'd have about another £7,000 to £7,500 of tax-free income. But largely, you get past £35,000, £4,000 level, and you're going to be paying tax at higher rates. Now, many of you may have structured partnerships. Now, there are some issues in and around your contracts, and there are some technicalities in this area. However, those that have managed to overcome those technicalities may well have structured your business as a partnership, perhaps between husband and wife, and in those circumstances, you can double up your profits over maybe a husband and wife dental team working together. You may have other members of the family that are partners. In those instances, the profit's over £70,000. You've effectively doubled your nil rate band, haven't you? And you may have formed a limited company. One of the reasons you may well have formed a limited company is that the tax with a limited company up to £300,000 is as low as 20% at the moment, upping shortly to 19%. And profits in that limited company up to £300,000 will be taxed at that level. Now what we do is choose one or other of those structures. Some interesting ideas in this area for you. Okay. Look at this one. Idea 1. Now to do this, a limited partnership is a legal entity and a corporate member. So it's a little bit like merging the two of the things on the other page there. So you know that if there are two partners in the business, the base rate of tax is 20%. I have two bands of 70%, and a small company is taxed at 20% up to £300,000. We have been able to set up these structures for dental practices or particularly dental family practices. And see that in those instances there, that income up to £270,000 can be kept at basic rate. And we've done it for quite a few people. We're in the process of doing it for the Tipton dentists very soon. So you can see, first instance, an incredibly simple idea. For half time, you might see that on a slide like this, and actually, you're never down to implementing. It just takes a little bit of time, a little bit of somebody prodding you in the back to make sure that you take in these steps. So that's Janet and John, step one. How about worry about all the boxes and such forth here. Imagine just for now that you're a sole proprietor dentist. And around for many years you may have an NHS practice and a private practice. Let's say that in this instance you had a private practice that was valued at £500,000. You could sell that private practice to a business. Sell the business to a limited company. There's nothing. Let's imagine you sold it for £500,000. You benefit that entrepreneur's relief that I spoke to about before, and you pay 10% of the £500,000. So roughly £450,000, ignoring any personal allowances. Happened? Well, actually, what's happened is you have a limited company that runs your sole proprietor business. That was a limited company that owes you £500,000. So you've now got a debt within this company of £500,000. You take income out of this limited company. As you're doing at the moment, you might take dividends or you might take a salary. Or this business over here, with chess business, may well be sufficient for you to live off, so you can take your income from over here. Meanwhile, this is a piggy bank that means you can take that £500,000 out of the limited company as and you see fit. A company pays tax at that 20% rate. Over here, remember, 50% plus your insurance. So a lot of people are setting up these sorts of structures. Again, it takes time. You need to get the business valued. All those sorts of things are hurdles, and that yourself is possibly a little bit time poor. But what came before, high tax is optional or accidental. So there's structures that can be set up, and many dentists are already setting up these structures. No one structure is right for everyone. Many people have parallel structures. I have two vehicles, just as we talked about there. That may be the answer for you. So I'm starting to raise your awareness, a little bit of knowledge. You can obviously revisit this, happy to take calls. But reality is, maybe I'm gaining your interest to say, I should spend some more time on this. Okay. Right, short term. Where now? Mostly through October, so November, December, January 31st, you've probably got a tax bill that you have to pay. So what options? Let's look at some tax-paying products. The thing that you buy. Structuring can't really affect your Jan 31st bill. And in fact, you're probably already doing some of these things. But let's have a look at the full range of things that become available to you in the next 10 weeks or so in order to reduce that January 31st bill. Now, what's unfolding in front of you is what I call a risk and reward pendulum. Quite simply, over on the left-hand side here, you have low-risk tax planning with low rewards. You have high-risk schemes and ideas which you can imagine have high rewards to go with them. So that is a little trick from this, which is gearing or borrowing. You may have done that when you've bought property in the past. And so spend some time in this area. So you are looking at pensions and ISAs. Pension, very good example. We'll have a look at it over leave. It's a government-approved scheme. For me, is that is written down in legislation as to what you can put into a pension, what you can put in an ISA, and what the rules are around here. So pension ISA is probably already on your agenda. As I say, truly at the low risk end of the scale. Now, I want to bring slightly higher across here into the slightly risk, higher reward, and introduce you to some of the government-approved tax shelters that exist today. First one, I mentioned it before, is an enterprise investment scheme. An enterprise investment scheme is effectively that which the government wants you to invest in enterprises, i.e. businesses, new businesses, creating jobs, or existing businesses looking to expand. The expanding is lack of cash. So these, you can imagine, are very, very popular right now. Venture capital trusts are very, very much the same idea. Government-approved vehicles for you to invest your cash into acquiring businesses. Probably too. I think most people have heard of them, but have anybody really taken them to heart? We're not sure. I'd be surprised if you've heard of this little government initiative here, but you will have seen it. This is called Business Premises Renovation Allowance, and what it is initiative the city centres going again. Certain city centres, and particularly after the property boom, buildings in the middle of them that are derelict, that need renovating, are empty. Now, the government has done this in the past, whereas it's given tax breaks to people that want to go into property. It's a timed process, and it works well. So this is about a building in the middle of a designated area, perhaps Birmingham, Liverpool, Newcastle, those sorts of areas, and effectively the government will give you very substantial tax breaks for investing in those property projects down there. More details very soon. Now, the BPRA, Business Premises Renovation Allowance, can borrow money. The galvanizing effect that borrowing money does have on these tax products down here, and I'll demonstrate that to you very shortly. Let me spend a little bit of time over here. So here are the things that people do involved in that the government completely disapprove of, and you'll see why when we look at some figures shortly. Partnership is if you going into business with somebody else very similar to these things, but not in legislation, and you invest money into a partnership to enable the other partners to go off and do something. This also involves gearing. The most well-known of these instances here have been film partnerships, seem to get all the publicity, and they do give very, very significant tax breaks. But then on top of that, all sorts of tax schemes where very clever people, perhaps in Pump Court Chambers in London, would fit an anomaly between two sets of rules. And they throw off huge tax breaks to individuals and a amount of tax relief based on the investments. And consequently, these are not in government legislation. The government disapproves them, and the government will bring out rules around the schemes, government disapproving of these things. They will fight you when you invest in this area. But some have an appetite for risk that means they like these arrangements. And you why shortly. Okay, wow, look at that slide. Let me take you through it slowly just to demonstrate the risk-reward profile that I put up on the other page. Right, many of hope have already got your ISAs topped up to. Well, when you put money into an ISA, you get tax relief. But there's limit. You can put it in one day, take it out the next. To demonstrate this, let's look at the cash flow of these various products. If you invest £1,000 into an ISA, you get no tax relief on it, so your cash flow is now down by £1,000. However, you pay tax on the money that's in that account. And the government love them. They regularly increase these products so that you'll put more into them. On pensions, it varies, depends on how much tax you pay, but there's a limit. The time limit is you cannot access your money before the age of 55. Let's have a look at the cash flow. £1,000, perhaps in tax relief, so your cash flow is negative £600. Benefits when they come out, some tax-free cash, but largely taxed, approved, absolutely. This is one of the areas that we spoke about, and we also noted that the tax relief in the IAS has just been improved to 30% from 20%. The government wants you to invest in enterprise investment schemes. You can see it's very attractive because it's 30% here, but the time limit is only 3 years. So £1,000 in, £100 of tax relief, whether you're a 20p, 40 or 50p taxpayer, and flows now minus 700. Benefits, there are no tax on the way out. No tax on the way out of those benefits. No capital gains tax. So is government approved? Absolutely. They have increased the rates at which you're going to get tax relief on this. Simple products, but you can see there's an old venture capital trust, certain rules. One of the differences is 5 years, but does very, very similar things. This, perhaps the building project that I spoke to you about before. Look at this. And this is due to two things, which is the government initiative plus the effect of borrowing money to invest as well. So typically, a business premises renovation allowance will give you 82.5% tax relief. There's a price for that. And it is that the money is tied up for 8 or 9 years. Investment of £1,000, tax £825, cash negative £125. Must remember to put that minus sign back on there. And bizarre that the prices of this are taxed as capital gains tax. So you get tax relief at 82.5%, and you well get tax down here at 10, 18, or 28 on some of the proceeds. Government approved? Absolutely. That's why the government have just extended this program for another 5 years. The risk areas, remember the partnerships that I spoke to about a moment ago, tax relief, just look at this, 200%. By a government disapproved scheme. That's the effect of hearing and the rules that the government apply to these sorts of things. Tails. Typically, a partnership will run from between 3 and 5 years' time. Just look at this here. £1,000 of your cash invested to a 50% taxpayer could generate a tax rebate of £2,200. Your is now plus £1,200. Not only when the benefits come out, next. Is there a seal of approval on it? Absolutely not. Is it legal? Absolutely yes. This just use rules as they exist today. So it is tax avoidance. It's effectively investing into an area that gives you high tax benefits. Risk is revenue will challenge the structure of the partnership, perhaps saying that it's not commercial, perhaps saying that the only reason you invested in this partnership was to save tax. They will challenge you on that basis. So what you might want to call a tax scheme. Scheme is purely a paper transaction, something that happens on paper, and overnight it creates a loss in your against which you can offset your income. This, I would think, is for the super wealthy or the super risky, and highly up to you. We trade our area in here. We think there's lots of benefit here, but we do know about these things and we can access them. So what are we talking about? Well, you can see that the time is zero. This is an overnight transaction, much shorter than everywhere else. So just with this, £1,000 invested could generate a tax rebate of £4,000, which means your flow is £3,000. So there are no benefits because there are no outcome, because there's no investment return. There's no tax coming out. You know the answer to this next line. This is 101% government disapproved. A lot of information. Effectively, you've had a whistle-stop tour of probably most of the things that are available to you right now. So, to bring to a finish, as a start, we went to you 6 steps to a smaller tax bill. Step 1, hopefully inspired you to prioritize tax planning as important. If you're going to work so hard to generate those profits, why don't you work a little harder at keeping them or understanding your options? Please, step 2, start to understand your tax calculations. Have a look at last year's. Somewhere in your inbox will be your tax calculations for January 2011. Now, step 1, prioritizing your tax planning. They would hope that you will have your tax calculations for January 2012 in your hand. Some of you may be smiling right now, thinking, my God, I must get those accounts sorted. Please don't leave it until Christmas. It's too late. So start to understand your tax calculations. Obviously, you can't understand them if you've not done them. And then you to leave it until Christmas is because you need to start to choose the products, rule them out to reduce your January 2012 tax bill. Once done, step 4, we should check your business structure is the most tax efficient going forward. Assume just because you started in one way, it's still the right way for you. So that's step 4. Step 5, it's all very well thinking and talking about this. If you don't take any action, it will stay the same. So it's point talking about it. Listening to this seminar is no use unless you do something about it. Step 6, because that was right this year does not mean it will be right next year. So create a review process. Very much linked to number 1, but effectively review every year what you're doing. Around December, sometimes before budget in March, there will be press releases, there'll be all sorts of things that are accessible to the public. So, 1, prioritize. Step 2, understand. Step 3, choose. Step 4, check your business structure. Step 5, implement. Step 6, review. Alternatively, as that's one of my outcomes, if you like our style, if you like our approach, into your life and your business. Because with your life and your business, we complete a forensic audit of your current arrangements, check that you are not paying unnecessary tax, and we make recommendations in line with your risk profile to save you tax. The next question would be, how much? Because association with Tipton Training, Connect Capital will waive their normal fees of £3,750 for this tax audit. Now, it's already to about 50 Tipton delegates, and I've received huge interest at the end of seminars. No action that's ever taken is if we contact you guys. I know how busy you are. I know what it's like to go back to a very full diary. But reality is, as I was saying, you currently start work for the revenue about lunchtime on Wednesday at the latest Thursday morning. So please take action. Call me, Tony Smith, on 07766 802200, or email me as below, tony.smith@canationcapital.com. We'll be delighted to start to help you. Hope you're useful, and please take some action. Bye now.